10 ways to invest $1,000. Number 1, invest $1,000 in stock market index funds. Investing in stock market index funds is arguably the best way to invest $1,000. These funds provide consistent returns and regular interest payments through dividends. Even investors like Warren Buffett praise index funds. Buffett once said, "A low-cost index fund is the most sensible equity investment for the great majority of investors." Whether you're looking to invest in your 20s or even your 50s, investing in an index funds is a great way to build wealth over time. Index funds give you exposure to the stock market through a diversified portfolio of well-established companies. Your money will grow at an average interest rate of 7% annually, adjusted for inflation when invested in an S&P 500 or Dow Jones index fund. Your portfolio will double in value every 10 years on average at this interest rate. This may not sound significant, but your money will grow exponentially. And another way to think about this, right? Because the reason why this is basically one of the best investments for anyone, especially the majority of the population, is because the majority of the population doesn't pay attention to investments, right? Like if you're someone who just wants to work a job that they love to work, right? Like you love your job, you love your business or whatever you're doing, then it makes more sense to spend all of your time doing that and then just tossing your money, like your spare money that you make, into an index fund, because it's basically guaranteed based off historical data that is going to continuously grow exponentially over the next few years, decades, and so on, right? Because you basically know that by the time that you are at retirement age, you're good. The money that you have is good, right? Like you don't have to really stress about your money at that point. So number 2, invest $1,000 in a mutual fund. Investing your money in a mutual fund is a great hands-off way to grow your money. A mutual fund is an investment vehicle where money is pulled from investors to invest in securities like stocks, bonds, and other assets. Mutual funds are operated by professional money managers who often have advanced degrees in finance and economics. The manager, along with their team of analysts, allocate the fund's assets to attempt to produce capital gains or an income for the fund's investors. This is one of the best ways to invest if you just want to grow your money without thinking about it. Mutual fund fees. According to Morningstar, the average large cap fund with assets greater than $5 million has an expense ratio of 1.45%. For example, if you invested $1,000 in an average large cap fund, you would have to pay $14.50 in fees annually. This is a small price to pay for your peace of mind, knowing that your money is managed by a professional. Now, this is also another reason why people sometimes prefer ETFs instead of mutual funds when they're investing basically for index funds, right? Because, mutual funds and ETFs basically do the same thing. You either just use basically a program or you use people. Number 3, invest $1,000 with a robo-advisor like Acorns, where there'll be a link in the description for Acorns as well. So if you don't know much about the stock market but still want to invest money, you might consider using a robo-advisor platform. Robo-advisors are investment companies that create software designed to automatically manage your portfolio based on certain criteria. For example, upon signing up, they might ask you what your investment goals are and what your risk tolerance is. Number 4, invest $1,000 in a real estate investment trust, which is a REIT, R-E-I-T. You don't need hundreds of thousands of dollars to start investing in real estate. In fact, you can start investing in real estate for less than $1,000. Shocking. A real estate investment trust, REIT, is a company that owns, operates, or finances income-generating real estate. REITs work much like mutual funds in that they pool capital to invest in assets. This allows you to earn dividends from real estate investments without buying, managing, and financing any rental properties yourself. Investing $1,000 in a REIT is a great way to start buying real estate. Over 80 million Americans, or roughly 40% of American households, own REITs. REIT shares are priced by the market throughout the trading day, like all companies that are publicly traded. What drives REIT growth? REITs will typically increase in price when their earnings increase. Growth in REIT earnings is typically generated by higher revenues, lower costs, and opportunities to purchase assets. Some major factors that affect REIT revenue specifically are building occupancy rates, increased rent, and property acquisitions. Number 5, invest $1,000 in a high-yield savings account. Now, I'm going to say this right off the bat. This is more for something that you're basically specifically saving for in the short term. So we're talking maybe like less than 5 years. So this could be like a down payment for a house. This could be a brand new car that's been pre-owned, basically, to save a little bit of extra money. Or this could be even like a new bike, a new motorcycle, etc., something smaller, right? But basically, obviously, since it's just $1,000, but the whole purpose of a high-yield savings account is to get a high interest rate on something for a specific reason. So opening a savings account is often the first step people take to take control of their finances. Savings accounts are a great way to stash cash for the short term. Consider checking out CIT Bank's Savings Builder account to get started, or their Savings Builder account offers some of the highest interest rates of any savings account. And you can also check out Ally Bank. While savings accounts are a safe way to store money, they are anything but lucrative. The interest rates are so low that you will probably lose money after adjusting for inflation. But the thing is, they're better than sticking it into a normal, local bank, nationwide bank, right? So investing $1,000 in a high-yield savings account is a great idea if you want to be able to access your money quickly while earning a reasonable rate of interest. So what is a high-yield savings account? A high-yield savings account is the type of deposit account that typically pays a higher interest rate or has a higher annual percentage yield, APY, than most savings accounts. High-yield savings accounts offer the same security benefits that you'd expect from a normal savings account. The Federal Deposit Insurance Corporation, FDIC, secures the balance of accounts in banks or thrifts, and the National Credit Union Share Insurance Fund covers accounts at credit unions. Number 6, buy savings bonds. U.S. Treasury bonds are a great long-term secure investment that will provide you with an ongoing source of passive income. Investing $1,000 into U.S. Treasury bonds might be the right choice if you want to have some more stability in your portfolio. Savings or Treasury bonds are issued by the United States government and are some of the safest bonds you can buy. You would typically make a 1 to 3% annual return when investing in U.S. Treasury bonds, but the interest rates change regularly. This is not the best way to invest $1,000 to build wealth, but at least you know you won't lose your principal. Bonds are typically safe, but the type of bond you buy will influence the level of risk involved with this investment. There are many types of bonds, including but not limited to premium bonds, treasury bonds, corporate bonds, and junk bonds. The safest option is to invest in the U.S. Treasury bonds. Number 7, open a Roth IRA. Opening a Roth IRA is a great way to invest $1,000 for retirement. A Roth IRA is a type of retirement account that you fund with post-tax income. You are free to withdraw any contributions you have made tax-free, but you may have to pay taxes on earnings. You have more control over a Roth IRA than you have with an employer-sponsored retirement account. So when should I open a Roth IRA? You should open your Roth IRA early when you are young and in a low tax bracket. This way, you'll be able to make contributions while paying minimal taxes. Roth IRA contributions. You can contribute a maximum of $6,000 in your Roth IRA, $7,000 if you are age 50 or older by the end of the current year, if you're single or the single head of a household. This is predicated on you having a modified adjusted gross income, a MAGI, of less than $122,000 annually. A Roth IRA can be a fantastic savings and investment vehicle because it provides tax-free growth and qualified withdrawals, says Daniel Shute, MBA Independent Personal Wealth Manager, Credit Wealth Management, Denver, Colorado. Remember to open your Roth IRA as early as possible to get the maximum benefit. Number 8, try peer-to-peer lending. Another great way to invest $1,000 is through peer-to-peer lending. Peer-to-peer lending, which is P2P, is the practice of lending money to individuals or businesses through online services that will match you with a borrower. You can expect to make a 3 to 7% return annually through P2P lending. Peer-to-peer lending is a relatively new way of investing your money, with Prosper First launching in the US in 2005. Here are some peer-to-peer lending platforms to get you started. Upstart. Upstart is one of the most popular peer-to-peer lending services available. The founding team of Upstart consists of former Google employees, including Dave Juryard, former VP of Apps, and Anna Councilman, former manager of Global Enterprise Customer Programs. And then there's Lending Club. The Lending Club is another US-based peer-to-peer lending company headquartered in San Francisco, California. It was the first peer-to-peer lender to register its offerings as securities with the Securities and Exchange Commission, which is the SEC. They were also the first P2P service to offer loan trading on a secondary market. A word of warning before we move on to the next section: borrowers can potentially default on your loan, putting you out of pocket. So this is really kind of like the end of stuff that you basically do, right? Your last bit of money, your last bit of $1,000, right? Just because you could get a really good return from it. And it's basically equivalent to kind of gambling because people could just default, right? So keep this in mind when considering peer-to-peer lending as a means of growing your wealth. Number 9, pay off debt. I bet you didn't expect paying off debt to be an investing article episode, but hear me out. Having debt is basically the opposite of having an investment. You're paying interest back to your lender instead of earning it. You can expect to earn about 7% annually through the stock market, while you could be paying double-digit interest back to your lender. This is why so many financial gurus like Dave Ramsey recommend paying down non-mortgage debt before investing for retirement. And investing $1,000 to pay off debt could make a huge difference. If $1,000 doesn't fully wipe out your debt, you should be focusing on paying it off as soon as possible. Number 10, invest $1,000 in your kid's college education. Every parent wants their student to live a successful life, and one path to success is through college. But the fact is that college is expensive and is showing no sign of slowing down. Investing $1,000 now doesn't seem significant, but it will create a path for future investments into your kid's college fund. The average cost for 1 year of college from 2015 to 2016 was $26,120 or $104,480 for 4 years. You could graduate with the same 4-year degree in 1989 for $26,120. So the average price for a 4-year college degree increased by 2.6% annually throughout this period. According to the Federal Reserve Bank of St. Louis, wages only grew by 0.3% annually from 1989 to 2016, meaning the average college tuition grew 8 times faster than wages over the same period. So if you want your kids to go to college and you don't have the money ready now, you should consider saving for their college education. So the best college fund is the 529 or 529 College Savings Plan. If you're looking to invest $1,000 in a college fund, the 529 College Savings Plan is a great choice. This plan has high contribution rates depending on your state and lets your money grow tax-free. The right 529 plan will give you the option to change the beneficiary to another family member. So if your firstborn doesn't want to go to college, you can use the funds for the next in line. Check out 40inbox.com for mastering your money, personal finance lessons and courses. Want to make money online? Learn the 4 steps to make money online in the description of this episode.